thank you to everybody for coming on and learning about multifamily. This is a very big passion of mine. I've been working in real estate development from a very high level for many years, and I really love what I do. And so along the path, I have had the opportunity to come across some really great people who are doing amazing things. And so we're going to hear from one of them tonight, Spencer Gray from Gray Capital. But before we introduce him, I do want to make mention of a few things. So within the group, we have a Facebook page and an Instagram page that we're trying to grow. And we'd love it if you guys joined us. So it's called Westchester Real Estate Investors, spelled out, Westchester Real Estate Investors. So if you're not on the Facebook page, the Facebook group, please join us. We try to, post things, that pertain to real estate investing, and there are others that make posts. And so I try every Friday to choose one person that I know personally to do a shout out for. And that could be anyone from, an agent to a CPA to an attorney, you name it. So please join that group. That'll be great for you to learn and to connect with people. Our next real estate investor mixer is going to be held on April 6th. So that is going to be at the same location as always. We haven't posted the event yet in Meetup, but it will be live tonight. So you'll want to RSVP for that. So very excited to get started. But I do want to share a quote with you guys because I don't want to just completely disregard, all of the stuff that's going on in the media, with the virus and all of the scares. But one of my favorite quotes, that just keeps kind of going over and over in my head is from Warren Buffett. And he says, be fearful when others are greedy and greedy when others are fearful. So I'm just going to leave that for you to think about. This is going to be a great session to learn how to build wealth and how to get involved in multifamily. So without further ado, I'm going to introduce Spencer Gray from Gray Capital. He's going to talk about his business and what he's doing across the U.S. with apartment communities and larger multifamily and office space, all different types of asset class. So we're gonna introduce him. Thank you so much for being with us.
No, absolutely. Thank you for having me. I've been looking forward to this. I'm excited to be on the first webinar, so that's very exciting. And like you, I'm also very passionate about multifamily. The more you learn, the more you love, and then once you start really getting some experience with it, and kind of down the road, it just kind of keeps getting better and better. And I'm also passionate about talking about multifamily and real estate in general with others. Just the concept of investing in larger apartments can seem very daunting and more complex than other strategies, especially when you first start taking a look. So I've had the pleasure of talking to a lot of people and helping them through the process because there have been so many people that have helped me along my career and my path to getting invested and involved in multifamily. So I'm really happy to be here, and hopefully we can have a great discussion, kind of share some of my experiences, talk a little bit more about my firm, kind of our focus, our processes, our strategy, and then also just kind of breaking down some of the nuts and bolts of how syndications work, how you can partner all the different levels of passivity, because there's a complete range. It's not always black and white. There's not just being a pure passive limited partner and between, being a full-fledged real estate syndication company with staff and thousands of units. There's a lot of in between. There's a lot of opportunities to get involved. And so looking forward to kind of talking about all that today. So, all right. So ready to get started? Okay.
Let's go.
All right. Let's see if we can share this. All right. I still want to be able to see the chat. And yeah, if anybody does have any questions in the meantime, I'm more than happy to try to answer that. I'm just trying to get the chat box open so I can see everybody. Show chat. There we go.
I can help you with the questions too along the way while you're giving the presentation.
Appreciate it. Okay. All right. So, kind of the first, I just wanted to go over some of just the macro multifamily thesis. And this is probably going to be a review for a lot of you that have been looking into multifamily or you already have some experience. But I always find it helpful to kind of go over some of the basics. You might see a little bit different angle than you're familiar with. Then kind of go into a little bit about me, my background, my firm, our approach, our strategy. They get into some case studies, some actual projects that we've been a part of or we've helped put together. Again, going into the process, the way we view multifamily investment, because we try not to take a kind of a single asset approach or just looking at doing one deal and really view it as more of building a true portfolio that can really focus on preserving wealth, creating streams of passive tax sheltered cash flow and be able to multiply that wealth over years. And then, like I said, I just want to get into some of the details of kind of how syndications are set up, some of the different structures, and then some of the different roles that investors can play in those structures. So, what are some of the benefits of commercial real estate? Just like the first benefit that why everyone's interested in investing in real estate is you get the direct ownership of real assets. Real assets as opposed to paper assets or certain ideas. I mean, investing in technology companies can be incredibly lucrative, but oftentimes you're investing in an idea and valuations that are are assumed and essentially kind of made up. And because of that, there's no real hard physical thing that is actually backing those investments, unlike real estate where you not only have a physical piece of dirt in the construction, but more importantly you have income, you have residents, and you have a constant stream of income, which is essentially how commercial real estate is valued. And that's where the real difference between commercial real estate and investing in single family homes, duplexes, triplexes, and quadplexes is how they're valued. On those 1 through 4 unit properties, they're valued based on the comps of similar properties in the area. So you can purchase a duplex that's run down, fix it up, and increase rents. And then that property may be valued based on other duplexes that have been fixed up, but the direct relationship on how that investment is performing and the income is producing is not directly correlated to the value. Unlike commercial real estate, where there's a direct correlation between the revenue of the property, the net operating income, and what it's valued at. And so kind of one of the most straightforward examples that I like to use is, let's take a 100-unit property. If you can increase the net operating income by, let's say, increasing rents $50 a month, if you take that over a 12-month period, and you divide it by the prevailing cap rate in your market, so let's say it's 6%, that's a $1 million of increased valuation to that property. And so it's literally whatever you put into that project, whether it's increasing rents, increasing fees, or reducing expenses, there's a direct correlation to the value. And so that's one of just the great advantages. You can go in and literally get in what you put out pretty effectively. One of the reasons why we invest in commercial real estate is the ability to have passive income that's sheltered from income tax. Now, there is depreciation recapture when you go and sell a property, but typically for the majority of the life of an investment, most of the cash flow produced from a property is essentially 100% sheltered from income tax due to depreciation and writing off expenses such as interest and some other things. And the tax law that was passed several years ago, while I know for all of you and living in New York, having the SALT deductions removed probably wasn't a great thing, but the accelerated depreciation and bonus depreciation that was put into that bill allows for a massive amounts of depreciation to be realized and even more tax savings. So it's really a really unique investment vehicle. The other reason is the way you're able to leverage commercial real estate. There's often a kind of a misnomer that commercial real estate and commercial multifamily properties The financing terms aren't as attractive as residential terms. And that can be true on some smaller multifamily projects that are usually under $1 million. These are usually, excuse me, limited to just private banks and credit unions. Once you pass a threshold over about $1 million and you can finance through Fannie Mae or Freddie Mac, you have access to some of the absolute best financing available anywhere. And especially if you look at certain types of financing, like HUD financing or FHA, you can get incredibly low rates. We actually just got quoted a couple days ago for a rate that I think it was around just about 2.75% interest. And if you've been following the market and where Treasury bonds are right now, those rates are going to be dropping even more. It'll kind of depend on how the lenders put in their spreads and if they expand their spreads. But incredibly attractive leverage, and the way that interest rates are right now, it's essentially it's kind of like free money. And because of that, the spread between interest rates and cap rates is widening. So essentially, the cap rate is the price that you're paying for that cash flow and you purchase a property. You look at the spread between what the cap rate is and what the current interest rate you're paying, and that's essentially what kind of yield you'll be able to achieve on your property. And so as that spread widens, the yield of those properties actually increases. So even though cap rates can be low in a very low interest rate environment, you still can get pretty nice yields in properties. We touched on accelerated and bonus depreciation. You'll find that in all commercial real estate asset classes, and it's just being more and more attractive. So why multifamily? Why isn't it an interesting asset class compared to other commercial real estate? I think that one of the best examples is just how the situation we're in right now, with the coronavirus. I have major questions about, the hospitality asset classes like hotels, commercial offices. People aren't going to be working in their offices anymore. Industrial asset classes, which, have been very popular with e-commerce growing, but things are slowing down, productivity is slowing down. But at the end of the day, residential and multifamily assets, people still need a place to live regardless, whether they're working from home or what happens. It's a true inelastic demand. No matter what, people need a place to live. But not only that is that there is not enough supply of housing in general, multifamily or single family. Now, it seems like there's been apartments that have been popping up absolutely everywhere. But really, if you look at what's being built, it's all, class A high-end luxury apartments. And, so it's essentially we're building 90% of the new construction is being targeted towards 10% of the population that can afford it, leaving a huge gap of majority of Americans needing a place to live. And there's no new supply coming into that sector. So there's an incredible supply and demand gap. There's more people who are just choosing to rent. They prefer the flexibility of renting versus owning a house. Many see a single family home as not necessarily the best investment, not viewing it as an asset, but more as a liability. You read a lot of Robert Kiyosaki or listen to Grant Cardone, they'll talk about that a lot. So there's just no new supply of this, workforce housing or housing for the vast majority of, everyday Americans. So just a little bit about myself and my firm. Again, Spencer Gray with Gray Capital. We're located in Indianapolis, Indiana. I actually originally was a music major in college. Before that, I flipped my first house while I was still in high school back in 2006. And from then, I have always sort of been involved in real estate one way or the other. Kind of got burned out doing music production and working in recording studios, and started flipping houses. I eventually started a business unrelated to real estate, and then eventually sold that business and started Gray Capital to focus on multifamily investments. I had been learning about multifamily investing essentially since the Great Recession, but around 2015 is when we really started the firm and got serious. Luckily, we were able to accomplish a lot in a short period of time. And the only reason we were able to accomplish so much is because we were able to find the right partners, find some really great mentors, and really understand that we were going to be able to achieve a lot more working together with others than we would be able to accomplish just on our own. So across our entire portfolio, in our investors' portfolio, we currently have around 8,500 units, mostly throughout the Midwest and the Southeast. So we participated in about almost just under $1 billion, $750 million worth of projects. Some of those projects, we were either a smaller investor or a smaller partner on. Others that we were either the lead sponsor or a co-sponsor on, and so it had a very significant role. About 40 assets. I think we're actually up to 42, and then we're active in about 8 separate states. This is just a little bit going into kind of our strategy and what we try to target. We only focused on stabilized assets, so we don't do any new development. We don't do any extremely distressed properties. We want to be able to go in, purchase an asset that is producing cash flow from day one. We don't want to go any period of time where cash flow isn't being generated, and we're not looking at putting any more money into the property other than what we've already set aside to put into the property after we've made our initial investment. So we're really cash flow and yield focused. We look at long-term holds, putting long-term fixed debt in place to essentially mitigate any interest rate risk, and in general, any timing risk. In general, humans, we all know that we're just bad at timing things. And to set up a strategy where I need to buy something and I have to sell it in 2 or 3 years, that might work and you might be able to make a lot of money doing that. But there's also a higher risk that something may happen in that period of time. So when we look at purchasing a property, we want to be okay with owning that property for, extended period of time or even forever. We're probably never going to own anything forever, but we want to be, comfortable holding on to that asset in case there are any economic conditions that aren't a good condition to sell or exit the property. We focus on value add real estate as well as core plus. Core plus is essentially newer but not brand new assets when we use leverage. So we're looking at very late 90s, early 2000s properties. One of the reasons why we've switched to doing a lot of core plus versus just value add is essentially so many of the value add properties have been so popular in the past several years, and the difference in cap rates between a value add project and a core plus project, a newer project, they've come closer and closer. And so when we can make the same return on a 2004 built property versus a property that was built in the 70s with significant deferred maintenance, we're going to go for that nicer, higher valued property versus an older property that may have problems. We still do value add projects, but they're just harder to find that are truly value add, just because so much of the inventory in the market has already been purchased and renovated, essentially. So just a little bit more about us. We personally, myself, my internal investment group, and a lot of my family members, we make large co-investments into all of our projects that we put together. A lot of sponsors do this, but you also see a lot of sponsors in groups that are not really putting any of their own money in the project. We're significant investors in our own project. We believe that creates a lot of alignment of interest, everybody kind of moving in the same direction, and just really kind of aligns what everyone's trying to achieve. Like I said, we've done just about $1 billion worth of transactions. We work with a lot of different groups. We're not loan operators. We do a lot of joint ventures. We do a lot of partnerships. And, as you'll hear me mention a couple of times, this is really a team sport. Very few people can be successful in commercial real estate and multifamily without a team and partnering to some extent. Whether you're partnering with a company, you're partnering with a couple of other, people who are either raising capital, finding deals. It's a true team sport. So we've tried to align ourselves with multiple groups. So for example, we don't do property management ourselves, but we have a lot of partnerships with property management companies who will partner with. They'll put some of their own money in the deal. We'll put some of our own capital in. We'll both raise capital together, form a joint venture, and take down a property that maybe just one of us wouldn't be able to do by ourselves, but together we can take down, larger, more efficient assets. You know, we're more focused, like I said, we're more focused instead of doing one deal. We're much more focused on building a portfolio. So we don't have single asset risk. I was having a conversation earlier today, and it's so hard to identify, what that home run will be. And, some of the projects that, we'll think are going to be good, kind of average performers, end up being some of the best performers. And some of the deals that you think, all right, this is a no brainer, this is going to be a home run, huge return, they end up being average. You really don't know everything about a project until you really get in there. No matter how much due diligence you can do and how well you can underwrite, it's nothing like actually getting into that property, really understanding it, and really seeing where you can take it. So that's why we try to do, multiple projects. That way, if one underperforms, another one is probably going to be overperforming, and we're hitting the mean. Again, if you think you can just pick out that home run and kind of hit the max return possible, you might be able to. But again, I haven't been able to find too many people who can really they can just pick them. And you look at some of those higher return deals, a higher return has a direct correlation to higher risk. So there's usually a reason why the return can be so high. We're focused on long-term relationships, whether it's our partners or operating our partners and our investors. We're in this for the long haul. And because of all of our different partners and connections, groups we work with, we have a lot of opportunities. And so we're able to scale pretty quickly and deploy capital pretty relatively efficiently. Like most sound operators, we try to take as conservative approach as possible, with the first rule to not lose money, and the second rule, to follow the first rule. We were strong believers in cash flow. Strong cash flow can really mitigate a lot of problems. We're going to look for permanent fixed rate debt to eliminate interest rate risk. Again, we're looking at long-term hold mentality. Now, there may be a great opportunity to sell a project earlier than 5, 7, 10 years, but we believe having the mentality to be okay holding on for the long run is really important. We really focus on C+ through A- class assets, but really with the majority of our portfolio being B class assets. A lot of that is just because being in C class assets tend to outperform some of the higher end and some of the very lower end type properties in economic downturns. We focus on growing markets. We like diversified economies. We also like markets that are a little bit off the radar. We're not in any of the primary markets like New York, San Francisco, Los Angeles. There's so much capital in those markets, and they've driven the prices up and the cap rates down so low that, for us, for cash flow investors, it really doesn't make sense. And I can imagine some of you, being in New York, you're obviously very familiar with that, and it can be difficult to find good cash flowing deals in your market. Now, there's great opportunity for appreciation, and it's a totally different strategy. But if you're really focused on cash flow, it can be very difficult in some of those gateway markets. And again, we're focused on really building tailored portfolios versus a single deal. These are the markets that we're currently active in. As you can see, we have a lot of assets in Indiana. It's our backyard. We know it really well. We have all the connections, but also Kentucky, Ohio, Illinois. And then we have several assets outside of the Midwest, Louisiana, Texas, Tennessee. And some of those are some medical office buildings and some other asset classes that make up a much smaller percentage of our portfolio. And we found some great partners where we're relatively passive in those projects, but we find them to be very attractive. So like I said, about 90% of our portfolio is multifamily, and about 10% are other asset classes, with the vast majority of those other asset classes being medical office buildings. I could do a whole webinar on medical office thesis. I think it's very strong also, but just going to talk about multifamily. And again, value adding core plus kind of makes up our strategy. So this is just a recent chart of our current portfolio. Again, 90 and 9.6. This is a pie chart just to kind of show you of what you can do over time. This is our current, this is the Gray Capital portfolio as it is today. As you can see, we have quite a few assets, And, our largest holding is about 9% of the total portfolio. And so if that property is having some issues, it really doesn't affect the overall return of our portfolio. This is a little bit about just the mix of the breakdown um, of what types of asset classes. So you can see 60% is B, right now about 25 is A, and just under 14% is C class properties. Just a little bit about our criteria. When we're looking at a value add project, we're looking in secondary and tertiary markets. So this example of the secondary market would be in Indianapolis, or a Columbus, Ohio, a Louisville, Kentucky, and then some tertiary markets might be a Fort Wayne, Indiana, a Dayton, Ohio, similar markets that are a little bit smaller. You always look for trending demographics, population growth, job growth, wage growth, the cost of housing in the market. We tend to look at projects that are in between 5 million and 100 million. 100 million is a big number, but if we can put the deal together and find the right partners, we would never want to pass on a deal without trying to put it together. Value add, we're looking at mid 1960s to 2000, suburban and urban. Mostly 100 plus units. We'll do a smaller deal if it makes sense, but we try to stick to 100 units plus based on the efficiencies. We're targeting at least 8% cash on cash returns, trying to trend to double-digit returns after the renovation and, say year 3. And we're really targeting a 15% IRR. And at least we're trying to double our money after, a 5 to 7 year hold period. Core plus, again, secondary, tertiary markets, the right demographics. A little bit higher purchase price, 10 to 100 million, 2000 to 2019 vintage properties. And again, suburban and urban. We're looking at, we're okay taking smaller lighter cash on cash in a core plus deal. Because more of your return is going to be coming from the sale and the value that you create. And the fact that you should be getting a slightly lower cap rate on a core plus on a newer project than you're going to be getting on a value add project. And so with a lower cap rate, the more you increase your NOI, you're just getting a little bit more leverage because of that lower cap rate. So you're getting half of the forced appreciation, for example, at a 10 cap property than you're getting at a 5 cap property. So we're still targeting a 15% IRR in a similar equity multiple over a 7-year period. This is just kind of the process that we try to go through. First you have to, and I think this is good for any investor. First step is you have to identify what your goals are and what strategy you're going to take to achieve those goals. Are you just trying to produce some passive income because you're retired? Maybe you're working professional. You don't have time to spend a lot of time in the nuts and bolts. You're really just looking to diversify your income stream, create separate streams of income. Once you've identified that, we believe in really kind of building a blueprint of your portfolio. So saying, over the next, 3 to 5 years, I'm looking to invest X amount of dollars. I'm going to try to spread that over, 5 to 10 deals. I'm going to try to do 2 deals a year. And based on what you're trying to achieve, whether it's more cash flow, or maybe you're investing in a retirement account, and since you don't have access to that cash flow, you're really just looking for more for appreciation and trying to grow that nest egg. And so maybe you're going to look at more core plus projects that have a higher chance for appreciation. But you want to build that blueprint so you know what to do and you know what deals you're actually looking for. And so you're not just doing any deal that comes across your desk. So then you need to identify opportunities, and that may mean looking for deals yourself, finding syndicators or partners to work with, and start increasing that funnel of deal flow so you can then find those specific deals that will fit your strategy and your blueprint. Then you have to do due diligence. Even if you're not the one putting the deal together, you at least need to do due diligence on the one who is. So, look up your sponsor, see what their track record is, what their specialty is. And then after you've vetted that sponsor, really, dig into the deal itself to really understand it and to make sure you're comfortable and you think that, the assumptions that the operator is giving you make sense and the thesis, again, matches your goals. Then you have to execute, you have to invest in the deal, buy it, And then once the deal's operated, even if you're not the one running the deal, you still have to perform asset management. You can't expect what you don't inspect. So, following up with your partners, reading reports, asking questions, and then evaluating that performance. Is your strategy achieving the goals that you set out? And you're always having to reevaluate, and maybe you're shifting your strategy a little bit. We were mostly focused on value add, and about a year and a half ago, 2 years ago, we shifted to a little bit more core plus, as we saw that there was no longer the risk premium on value add projects. So we shifted more to, core plus. Just going to give a couple examples of some current projects that we have going on. It's a property down in Bloomington, Indiana, the home of Indiana University. We purchased this property back in 2016 for $10 million, 200 units, was built in 1972. The business plan was relatively straightforward. We were going to go in, upgrade the units, put in LVT flooring. We were going to refinish the cabinets. We were going to resurface the countertops. We weren't putting in granite or anything like that. New light fixtures. Overall, it was about a $5,000 per unit renovation. We were able to achieve more than $150 rent premiums after that renovation. In fact, it ended up getting up to right now around 200 plus, which is over a 36% return on that renovation. Last year, the property was reappraised at a value of $18 million, and that's a direct result of the forced appreciation from the value add and additional cap rate compression from the market improving. And so actually 2 weeks ago, we finally closed on a refinance. It literally took about 10 months to actually get done. We were able to pull $4.5 million out of the property. There was $2,120,000 of equity that was needed to purchase the property. So we were able to return 100% of capital, give everyone a nice return, and then retain ownership in the property, and actually just keeping the loan to value at 75% of its new value. So it's going to continue to cash flow. We've actually, the week after we closed on the refinance, we were able to deploy that capital into a new property that's going to be putting off around 8%. And so those two returns put together on that original capital, we're going to get some really nice compounding and really have double-digit returns with the two investments combined. But the Oakdale Square investment, all investors have essentially an infinite return at this point, since it's been completely de-risked. The money's off the table, and essentially we're playing with the house's money at this point. So in my opinion, this is an ideal scenario where you can go in, you execute a business plan, you de-risk the investment by getting your money back, but you're able to retain ownership, continue to build wealth. It's going to continue to increase in value, and be able to continue to receive cash flow. So, we're projecting over 50% IRR, since, the IRR is already around 15% and we still have ownership in it. And we were targeting just a 16% IRR originally. This is another property, similar business plan as as Oakdale Square. This property is called Fountain Park. It is located in Indianapolis. 240 units, built in the late 60s. And this is an example of a property that it was built in the 60s, but it was in absolutely excellent condition. We've been involved in some projects where it was built in the 60s, and there have been so much deferred maintenance through neglect of previous owners that, it's such a can of worms you get into, and the problems continue to compound and compound. This was not the case with this property. It's just a great example that when you keep maintaining an asset, you really can extend its useful life. So this is an $18 million purchase. We're able to increase the rents about $200 a month, get a nice return on that renovation, and it's putting off above a 9% cash on cash return. We're looking at refinancing this property also, hopefully to close on it probably before the end of the third quarter. So we still have high hopes for this project, and we'll see how it goes. This is an example of a Core Plus investment we made also back in 2016. This is located in downtown Indianapolis. It's 105 units, so a little bit smaller. It was originally built as condominiums. They were converted to apartments just after, since it was ended up being finished construction just at the end of the Great Recession, built in 2010. So obviously the financing that was available before the Great Recession wasn't available anymore, and the project struggled as condos. So someone came in, converted them to apartments, and have been running them as market rate apartments ever since. We're able to purchase it below replacement costs, and it's more of a value and appreciation play. It's a location play. It's at a great location downtown. So we're taking a lower cash on cash. It's about 6%, which is, it's a little bit below our typical return targets, but the quality of the asset and the location kind of justifies that. And, there's two places where you're going to get your return from: the yield and cash flow, and then the value at the end of the day when you sell or refinance the project. And so we're going to get more of the return out of the sale and the value creation on this project than we are cash flow. But at the same time, it has to cash flow, and we're happy with our 6% cash on cash. Gateway Crossing, it's an example of a core plus project, but still a garden style apartment community. A garden style, we're very, very typical out here in the Midwest, usually built, right now there's, we have all kinds of cornfields out here in Indiana. As the suburbs grow and grow and grow, we have a lot of flat land. It's easy to build these large communities of several hundred unit apartments. These were built in 2004, so they're still in good condition. And this is an area of high growth. It's in just a submarket just outside of Indianapolis. And it's an interesting situation where there's not a lot of competition in the immediate submarket. So if you want to live in a nice apartment that's still affordable in this area, we're really one of the only options, unless you want to kind of go a little bit further out. So on this specific property, we haven't been able to find a ceiling of where have we been able to increase rents. We're going to hit it eventually. But we just kind of keep bumping rents every month, $25, $50. And the residents have been fine with it, and we're still able to keep it occupied above 95%. So, it's cash on cashing about 7%. One of the reasons for the slightly lower cash on cash than you would imagine is we financed this through a HUD 223F loan, which is a great loan product through the Federal Housing Administration. It allows you to have a 35-year term, 35-year amortization, and a very low interest rate. So that 2.75% rate I was talking about earlier, that was also from a HUD loan. And the downside is that there's a little bit more strings attached. You end up having REACT inspections. So HUD will actually come out, inspect your property, and will give you a laundry list of things that they're going to want you to complete. You also have to follow ADA regulations a little bit closer. And there's also a calculation of how much cash you're able to distribute from the property. So HUD requires when you finance through HUD to keep very large reserves, and you have to keep the majority of cash flow in the deal itself. So we have to go through a surplus cash flow calculation to see how much cash can be distributed, which ends up limiting distributions and returns. So it's a great loan product for the long term, but it can attenuate cash flow a little bit. So after those case studies, I just want to quickly talk about how, we were able to scale going from, essentially no units to 8,500 units in about 5 years. I had just sold a business. I was able to wrap some of my family members who had also sold businesses. So, we did start out well capitalized. That doesn't mean that you have to, but if you're going to start investing, you do need some capital if you just want to be an LP to invest. Now that if you don't have any cash and you don't have any capital contribute, there's still a ton of ways you can get involved in multifamily investing. But one of the ways that we were able to accelerate our progress is that we were well capitalized, we had the plan, and we built the teams and we executed. But beyond that, the most important thing, the way we were able to scale, is the quality of partnerships and the idea that we weren't going to go solo. We had to build a team, And like I said, we want to be able to accomplish a lot more working with others than we were just going to be able to accomplish on our own. We built the strategy, we were specific, we had our criteria, and then we executed. We didn't, certainly we spent a lot of time analyzing and putting that strategy together. And there was years in the past where it was more analysis paralysis and looking at deals. But you have to execute. You can't just think about it. You have to take that first step, make that first investment. And it can be nerve-wracking. But that first step is the hardest. But once you've taken that first step, you're just going to keep going. We weren't necessarily concerned at first about, we need to be the ones that are running the deal. So our first investment was an investment as a passive limited partner in a project. Very quickly after that, transitioned to being a co-sponsor and a co-GP with some other apartment operators. Then we started forming joint ventures with operators. As our investment group grow, we added to our team, and we were able to find deals ourselves. We started running the deals, but still leveraging not only the resources, but most importantly, just the experience and the knowledge of our partners. I'm learning something new every day. I'm hoping that I'm going to learn something new every day for the rest of my life. And there are those out there who have, been, they are where I want to be. And there are people that are where you want to go as well. And so to be able to use their experiences and to avoid those pitfalls, you're able to really mitigate a lot of risk. And, you don't have to reinvent the wheel and make all of those mistakes on your own. You're going to make a ton of mistakes, but if you can accelerate that knowledge and reduce the amount of mistakes, you're going to be much more successful. When we started, we wanted to just go out and let's go buy an apartment building. And, the more we learned and as we analyzed deals, we realized, do we really think that we're going to be a better property manager than a property manager that's been doing it for 10 years? Are we really going to be able to analyze this deal as good as someone who's done 20 deals? What are we risking by just assuming that we know? So we were able to partner and leverage that experience. And because of that, we haven't lost any money and all our investments have been successful. Not that they've all been home runs. We try to do a lot of, hit a lot of singles and doubles. And if we hit a triple, that's great. But again, that first rule, we're not losing any money. We're going to preserve our principal. So you have to have a team. It's a team sport, and there's really no way around it. You have to have an attorney, a CPA, operating partners, someone that's maybe doing underwriting analysis. You have to have brokers, lenders, mortgage brokers, a property management team, asset management or an asset manager, your maintenance staff. These are not all going to be done by one person. There's no one person that can do it all. And so by taking that really team mentality and being comfortable with it, because it's inevitability. A lot of people, are curious about what the difference between being a limited partner or a general partner. So I've just kind of broken out, just kind of the roles of what an LP does and what a GP does. So a limited partner is a passive investor. Essentially, you're going to be sending your capital to an investment company or a syndicator who they're going to run that project, and you essentially are going to have no say in those day-to-day operations. There's really nothing for you to do besides the due diligence, underwriting the sponsor and the deal, and to kind of track performance of the property. So you have to vet the operator, vet the project. You want to confirm assumptions. You have to commit to actually doing the deal. You have to review the documents, which usually include a private placement memorandum and a subscription document. You may have to verify your accreditation status if it's a 50C structured syndication. Send your money, and then again, you have to perform asset management and monitor your investment. If you're a GP, you're essentially doing all the work. An LP, you have to sign some documents, send your money, make sure you're comfortable with the investment, but that's not a lot of work compared to what the GPs are doing. So, I'll just go through this quickly. You have to find the deals. You have to underwrite and analyze the deals and know how to do that effectively. Build the business plan and strategy, how you're going to execute the due diligence. You have to put the team together. You have to not only source, but you have to guarantee the debt, which is a hurdle for a lot of projects. You have to provide earnest money, raise the capital, negotiate, manage the property, manage the project, marketing, reporting, distribute that cash, tax matters. And you also have to make those decisions. When is the right time to sell? When is the right time to refinance? And constantly be reevaluating those options. So you have the GP group, and there may be some more passive members of the GP group, but being an active participant means more responsibility. Now, there's still a lot of gray area. It's not all black and white, in that there are many people who are mostly an LP, but maybe are contributing to the project and may be able to receive a role in the general partnership. So some of the advantages of being an LP: completely passive. There's no personal guarantees on the debt. Your liability is essentially limited to your capital invested. Some projects may have a provision that there could be a capital call at some point. It's usually limited to a percentage of your investment, but essentially your total liability is what you put in the project. But you get to share in all the benefits of the project, including the depreciation, the income. Now, what kind of fees are you going to be paying if you're just an LP? Because obviously there's no free lunch, and if somebody's going to be doing all of the work, that takes time, that takes resources. And so I just put together just kind of a range of fees that are relatively typical in the industry today. Now, there's no typical structure, but this is what we see a lot. So there's typically an acquisition fee, 1% to 2% of the purchase price, a finance or loan guarantee fee, usually 0.5 point or 1.5% of the loan value being guaranteed. Sometimes there's an asset management fee that's 1% to 3% of gross revenue. Disposition fee, you can see at the end of the deal, if it works out, it can be a percentage of the sales price. And then the biggest way that a sponsor is compensated is receiving promote on the project. A typical structure is an 8% preferred return to all money invested. And then any return after that 8% is split 70% to the limited partners and 30% to the general partners. So I just took an example, what that ends up being if the total project itself achieves around a 20% internal rate of return, or an IRR, that ends up being about a 16%, or 17 if you round up, IRR to the limited partners. So you are giving up some of your return. However, there's no essentially work to be done. And you're also, again, you're leveraging that experience from your partners, and you are able to hopefully avoid some of the pitfalls if you're just doing that project yourself. The way that we look at it as, you're paying some insurance for that project to be successful. And again, the first rule, not to preserve principal, to not lose any money. We're typically happy because, we've done plenty of limited partner investments ourselves. We're happy for our partners to make some money if the project's successful and if they do a good job. So if you don't have any capital to invest, or you have more time that you want to contribute to a syndication, and maybe you want to be a full-time syndicator one day, you want to start putting these deals together, there's a lot of opportunities to partner with somebody that's already doing it, to add value to that group and potentially be a part of that general partner group. Now, the value of what you're bringing to a group is directly related to what they need and the resources that they already have. If you approach a large company that has tens of thousands of units, they're probably not going to need any assistance, or you're not going to be able to bring anything to the table that they already have. But there's a lot of groups that do need assistance in one way or the other, or could accomplish more by bringing someone into the team that they're going to be able to accomplish on their own. And it's a really a win-win situation. So some examples. So, deal origination. If you can find a great deal, the two pieces for a syndication business, the two funnels that you need to be searching for are deals and capital. And so if you can bring a deal to a syndicator that works, hits their metrics, and they can achieve, that's an incredible amount of value. And most cases, a syndicator or a GP will be able to include you in the general partnership if you bring them a good deal. Typically, to finance these deals, there has to be a net worth in the GP group that equals the value of the loan. And you also need liquid assets that equal a certain amount of debt service payments. So if you are doing a $13 million project and you have a $10 million loan, you need a combined net worth of $10 million between all the general partners to be able to guarantee that loan. And typically, liquid assets, cash or stocks of $1 million. Most people don't have a net worth of $10 million or $1 million just sitting in their bank account. So again, you have to put a group of people together, and often groups will bring in a high net worth individual who does have a significant balance sheet as a loan guarantor or a key principal to help guarantee the loan. And that person is often compensated in some form, whether it's a percentage of the general partnership or a fee or some other form of compensation. So if you want to be a passive investor, but you have a large balance sheet, you could leverage that balance sheet and guarantee the debt, receive a piece of the GP, and possibly still be relatively passive, but have some accelerated returns. Now, signing debt increases your risk without a doubt. So you are taking on increased liabilities. And if you're interested in that, you definitely want to go over the concept with your CPA, your attorney, and making sure that you understand what you're doing. But if you can understand, you can become comfortable with it, it's a great way to accelerate your returns and still remain relatively passive. Maybe you're good at underwriting analysis. If you're a capital raiser, if you can raise a significant amount of capital, again, it's deals and it's capital. If you can raise a lot of capital, that can mean a lot for an investor. Or maybe you can just make a large equity commitment or a commitment to invest in multiple deals and say, what if I invest, $200,000 in your next 5 deals? What value is that to the syndicator? Maybe it's not a lot. Maybe they say, I've got all my investors are willing to invest in my next 5 deals, or maybe it's worth a certain amount of value. And they say, hey, if you can make that commitment to me, I'm happy to give you a certain percentage of the general partnership just to keep you along in our deals. Maybe you're an asset manager. Maybe you're a property manager. Maybe you can be the GC, you do construction, legal, marketing, CPA, anything of value that you can add to the group is certainly on the table. And that value is what is worth to the syndicator and what you're able to negotiate. So quickly, because I know we're running out of time, and I want to get to some questions, but I wanted to just do an outline of a typical syndication kind of private equity structure. So, we want to invest in an apartment building, call it Oak Tree Apartments, because at least all the apartments around here seem to be nature themed. You're an investor. How do you buy this building? So let's say that there's a syndication company out there they're in the business of buying these buildings. Call it GP Oak Tree Management. They'll bring in some GPs, build a team, create this entity that's going to be the management entity, then create an investor entity that's going to be the LLC that will actually own the property itself, called Oak Tree Investors. The capital is aggregated, syndicated, all as members and owners of Oak Tree Investors, LLC. And that group, that entity has direct ownership of the apartments themselves. So again, typically all money that's invested, and again, it's typical, but it's not there's no rule. It's what we do in a lot of our deals and is common. Most investors receive an 8% preferred return, an annualized preferred return. And then anything above that 8% return is split 70% to the limited partners and 30% to the sponsor or the GP group. Now, a little bit more complicated structure is a joint venture, and it's basically the same. It's just there's a couple other entities involved. So same Oak Tree Apartments. Here, let me back up a little bit. Sorry, I went a little fast. Do the same thing, Oak Tree Management. So this is a syndicator who has found the deal. They want to put the project together, but maybe they can't raise all of the capital themselves. So they go to another group. Let's say it's an institution, could be a private equity group. It could be another investment group, could be another operator, call it LP management. they create a joint venture company together that they both own. And oftentimes there's some sharing of decision-making abilities. For example, the GP group may have all control over the day-to-day operations. Maybe they can choose when to buy or sell, or maybe that the LP group that is contributing most of the capital, they might have the ability to make those major decisions, and have certain clauses that they can take certain actions that a typical LP investor may not be able to have. The GP group will probably syndicate a certain amount of equity into the JV LLC, and the LP limited partner will raise a certain amount of equity in the deal. So for this example, the LP Management LLC, they're bringing 80% of the equity to the deal, and the GP group is bringing 20% of the equity to the project itself. Now, essentially, there's a multiple waterfall tier. So all cash flow would be split equally, 80% to the LPs, 20% to the GPs, essentially kind of pro rata. All money is being treated equally. But after the LP achieves a 15% IRR, that waterfall switches, and then instead of receiving 80% of the cash flow, the LPs receive 60%, and the GP starts to receive 40. They'll say they hit a home run, it's an 18% IRR. Anything after that, it switches 40% to the LPs, 60% to the GP group. So now these numbers can change. It can be not necessarily based in IRR. It can be based off of an equity multiple. Those numbers can change. But this is typically how a larger deal gets put together. And it's another example of, it's not just the small deals where we're having to partner and bring different groups in. The largest real estate transactions are a group of multiple parties coming together to, achieve something, again, that they couldn't do on their own. So it's not just smaller investors that have to kind of pool the resources together. The biggest real estate companies do this. It's just slightly more complicated, but it's still very effective. Well, that is all I have for the presentation. Sorry I haven't kept up with any questions, but yeah, I'd love to answer any questions that anybody has. And yeah, so
Al would like to know what the definition of A class, B class, and C class.
Yeah. So, there's not necessarily a textbook definition, and it can change a little bit between who you're asking. A lot of it is determined by the age of the property. A lot of it is determined by the location, and then what condition the property is in. So starting with A class is going to be your newer construction or high-end real estate. So it may not be new. Maybe it could be 100 years old, but if it's kept well, the interiors are really nice. The finishes are very high-end. No, thank you, Natasha. It can be an A-class property. So it doesn't have to be age, but typically something that was built last year is going to be an A-class or an A-plus class. Now, again, that can go all the way down to A-minus. It's a lot of the things that we focus on, things that were built in the last decade, the last 15 years. They're newer, but they're not brand new. B-class, that's part of the largest groups of apartments. If you're going to go by age, it can be properties that were built in typically the 80s and the 90s, or a property that was built in the 60s that's been renovated. Typically, B-class properties, they're going to be charging essentially about what the market rents are in a typical market. So in Indianapolis, our market rents are around $875 for a 2-bedroom apartment. That's what a typical B-class property is going to be charging. Now, the A-class properties, they're going to be, several hundred dollars above. A C-class property, you're probably going to get $100 or a couple $100 below. C-class properties typically have some sort of deferred maintenance. There are some issues with it. Maybe there's a lot of turnover at the property. It hasn't been kept well. And oftentimes there's an opportunity to turn that C-class property to a B-class property through a value add program. And then really the difference between a D-class property and a C-class property is often the location. if your D-class properties often looks like a C-class property, but it's in more of a war zone, an area that you don't really want to travel to without, some kind of, firearm or something. But so yes, those are the rough definitions of the asset classes. So yeah, any other questions? I know we're running low on time, but happy to answer any other questions anybody has. And if not, I really appreciate everyone being here on the webinar, and for you all to have me and for this opportunity. And I hope everybody got a lot of value from it, learned a little bit. And if anybody has any questions about kind of what we do, or just want to learn a bit more about multifamily, if I can do anything, happy to shoot me an email, spencer@greatcapitalllc.com. You can check out our website if you're interested, greatcapitalllc.com. Yeah, we're happy to, just call, talk about real estate, what your plans are, what your goals are. Love for everyone to partner with us, but, no worries. Happy to just talk about real estate at the same time. So what is the real ask of the people on this call? I hope you're able to learn something, get involved in multifamily. And again, always looking for people to partner with us on projects, whether that is as a limited partner, or, we're always looking for co-GP partners. We always have room in our GP group, but, we're always looking to collaborate with groups. So, we are able to, the more we, they say your net worth is equal to your network. So, the more we can network and meet everybody, that's better for everybody. So, yeah, a lot of people don't have the funds to engage in this type of investment as just a pure limited partner, and that's where there are opportunities if you don't have the capital. Is typically minimum investments. A lot of syndications are. It can be $50,000, it can be $100,000, but that's where if you can add value to a syndicator in another way, whether you're finding the deal or if you're going out and raising capital. I mean, that's essentially how I started. I had some money to invest from selling the business, but I started first by getting other people involved and talked about the idea and started just putting an investment group together. That way, when I started partnering with other syndicators, I wasn't just, Spencer Gray, I've got a little bit of money here to invest with you. I was able to tell a story of, I've got this whole investment group. I can bring a whole group of people to your partnership over the long term, and can we establish more of a long-term relationship?
Hi, Angela. So I'm not sure if you've been to any of our events, but we usually do a mixer every month. And as the host of Westchester Real Estate Investors, we want to start providing people the the opportunity to learn, because we don't necessarily give a class in person, because we use our time together to interface with people and build relationships. So I thought this would be a cool way if we could bring different topics to the group. This month we chose to do multifamily apartment community investing. So there's really not necessarily an ask here. It's just more about, educating folks on, the different types of investing. So we understand that it's not going to be for everyone, but it's always great to know, about what's out there. And yeah, so I mean, if you want to be involved in it, there is different criteria for different types of investment. But yeah, that's pretty much the ask. It's just an informative webinar.
Absolutely. So how do we become comfortable investing outside of Indiana? That's a great question. And to be honest, we weren't comfortable when we started. By putting the right systems in place, and especially if you can partner with the right groups. For example, we've partnered with a group that are based out of Atlanta to invest in some markets in Georgia, and that took a while to define that group. But by partnering with someone with the boots on the ground, we were able to become comfortable with participating in out of state, and then we became comfortable through some of our own projects. And we were able to get comfortable because the projects we were doing, we were able to establish enough scale in a market. So, we would go in and we were able to buy, for example, in Dayton, Ohio, we were able to buy a 350 unit apartment community. And that gave us enough scale so we could, hire on-site staff, we could have people there every day. And, we have the resources there. So, you can invest anywhere in the country. Where we like investing in our backyard because we know it, we're going to know our market better than any other market. But it's important if you are going to invest out of state, to really understand where you're going to be investing, what that market's like, and, at least to have some conversations with some people that either live or are very familiar with that market. So you can, again, leverage their knowledge and experience. Legally protected. And so the first is, we're investing through limited liability companies, and usually a series of limited liability companies. We also, have insurance for the property, and usually an umbrella insurance property to cover a whole host of, legal actions. Today we've never been sued, never been in a lawsuit. Knock on wood, because you do enough business, you're going to get sued eventually. Now, certainly we've had some of our property managers, they've been in lawsuits. I mean, and you have to go to court significantly because, no matter what, even at Class A properties, there tends to be some evictions. You do have to take people to court. You don't have to have your own LLC as an LP. You can invest as an individual. You can invest through a trust. You can invest through a self-directed retirement account like a self-directed IRA or 401k. But there's no reason why you can't invest as an entity also. And it's really not that difficult to create an entity. You can have an attorney do it. It's also not too difficult to do yourself. It takes about 15 minutes, at least in Indiana. It's a pretty quick process. You need an operating agreement. You need an attorney to draft. Minimums, they're different from every project and every group. The most typical minimum investment that I've seen is $50,000. Typically, if you were going to, if you have a conversation, you have $25,000 to invest, oftentimes a sponsor will make an exception. You just have to ask, but 50,000 is probably the average. The average time for return on investment, I think the average time in the overall market is around 4.5 years. I saw that statistic recently. And like I said, we target, we underwrite for 7 to 10 years, but our average hold period will probably be that 5-year period because, especially on a value add deal, you are maximizing the value of the asset after the renovation and the rents have been increased. And so while you're going to continue to see organic growth on the investment, the most value has already been added. And the shorter the investment, the higher velocity of money and the higher IRR. So, when you have a great opportunity, you might look to refinance where you can return all that capital back, you get your principal back, you retain ownership, or you just look for a sale. So I would say the average time is about 5 years. But I would be wary of any business plan that said that the deal has to be done in 3 years or even 5 years. I think is fine. That's a long enough period of time. But you don't want to just count on having something take place in a short period of time. You want to use time for your advantage. You don't want time to be working against you. So I think that's a long answer to just what the average is, but.
That's a great answer.
Thanks. Cool.
Okay, if that's it for
All
the
right.
questions, we'll say good night. Thank you so much. We really appreciate your time and your knowledge and great presentation.
Appreciate it. Thanks, everybody. Good night. I hope everybody learned something and got some value out of this, and maybe just kind of expanded the idea of what's possible. Because again, these things can seem so big and so massive when you're talking about millions of dollars and hundreds of units. it seems so unobtainable from the onset, but it's not unobtainable regardless of how much capital you have. It's really what you want to achieve. And so if you put the plan in place, you can achieve it. So yeah, thanks again. I really appreciate you having me, Rochelle, for this opportunity. And if anybody has any questions, feel free to reach out.
Thank you. Thank you so much. Talk soon.
All right. Talk to you soon. Bye, guys.